I believe we are seeing, it's going to be incredibly confusing, I think, to people. Just look at what's happened to the bond market this year. Against all expectations, yields have dropped from, I think it was 1.75 at the peak in March down to 1.3 as inflation expectations are exploding, right? We believe the reason for that is that we're probably, when all is said and done and the dust clears from the supply chain problems and everything, we're probably in a highly deflationary world. And we see three sources of deflation. One is very good. It's called technologically enabled innovation. Artificial intelligence training costs are dropping 68% per year.
Right.
When a cost drops that much, the demand for it picks up. And artificial intelligence is probably the biggest reason we're seeing the convergences between and among technologies. So we've got one S-curve feeding another, explosive energy, incredible deflation. That's the first deflation.
While the rest of the world thinks, if you were here for part of the day, everybody's talking about inflation.
Oh, and that's what I love. If the whole world thinks that's going to happen, and a portfolio manager and analyst team thinks that's going to happen, well, if we're wrong, it's not going to matter that much, right? Because nobody's expecting it. It's not in the market. But if we're right, the returns are enormous. And I think that's what's going on with the technologically enabled innovation that we see, especially in healthcare, by the way. But there are two other sources of deflation. Disruptive innovation, there's another side to it. It's called creative destruction. And I think we're going to see more creative destruction than we have in all history during the next 5 to 10 years. Now, you can say, oh, you're just talking your book. We have rights law teaching us about learning curves and cost declines that suggest we are going to see incredible booms out there in parts of the world, but it's going to mean tremendous destruction in others. So when I say confusing, I mean that. And then the third source of deflation, I think, will be cyclical deflation. Most people are fighting us on this one. It's hard to fight us given our research on those other two. But this cyclical deflation, it started with lumber, $1,711 in May. Now we're at $500. Copper, $490. I think now we're at $425. Used car prices are surprisingly good, and I know we're getting pushed back on this one too. They shot up 60% as everybody decided to avoid mass transit last year, right? And now we find ourselves supposedly in a chip shortage. I do believe in the chip shortage. Because
you believe there's a chip shortage?
I do believe there's a chip shortage because the world's going digital. But I believe...
But wouldn't that be inflationary?
Well, I believe chips are the new commodities. That's the point I'm making here. So chips are going to be what Dr. Copper has been in the industrial world. This is Dr. Digital, I don't know, in the form of chips. But you hear the auto industry screaming. Auto sales have dropped from 18.5 million units in April to 13 million. Now, these are annualized rates in August. That's more than a chips shortage. What happened last year is people bought the cars. They're in their driveways, garages, didn't want to take mass transit. And now there's a decision. What do I want to buy? A gas-powered car or an electric vehicle? Well, that's where the short supply is. And I think the excess supply is going to be in the gas-powered side. So this is a really important test case of why I formed the firm when we did. I think the disruption is happening to the auto industry now. I think, as I said, if you're looking at the traditional benchmarks, they may very well be right. All I know is when we are looking at the transformative growth that's going to take place in our space, and we're completely devoted to nothing else but disruptive innovation, we see explosive growth. I think one of the reasons they will look right in terms of GDP is if the other side of disruptive innovation is creative destruction, well, what's happening? It's the industrial world evolving into the digital world as more of the physical world goes digital,
right.
Transportation importantly, right? And so the traditional benchmarks, GDP, the statistics that we look like are probably going to look pretty lousy at times, I would say. Certainly sector by sector as these transformations take. We just learned from Jolene Caruso that millennials are 70 million strong in our economy and now bigger than the baby boomers as a demographic. And I'm going to harken back to Stan Salvigson. Most of you won't remember who he was. He made one very important call in the early 80s. He said, baby boomers are going to be the reason that the equity market goes up for the next 20 years. It was a brilliant call. He's no longer with us. We're in the echo now. And I do believe that both crypto and the equity markets are going to be powered by millennials. In fact, Tom Lee at Fundstrat,
yep.
He has done the arithmetic the way that Stan did. And I think he says this bull market will not end at least until 2026, and maybe not until 2038 when the number of millennials peaks out there. Well, I went through it in the 80s and 90s, and nobody believed him, thought it was a ridiculously simple call. But when you look back in history, it was a pretty good call. I think there's something going on there socially that the government is very worried about. Many of the same things that the rest of the world is worried about, where there's the divide between the rich and the poor. I saw today Evergrande. There are protests around the Evergrande offices because the wealth management products that weren't highly regulated are not paying interest or not paying back and so forth. So I think there's social unrest taking place there. And that's why common prosperity has become the rallying cry, and hostage to capital has also become a rallying cry. So I don't think it's a very friendly place for capital now. However, focused only on innovation, China has, in its various 5-year plans, made innovation an incredibly important plank.
Right.
And so we don't want to avoid it, but what we do want to avoid is very high margin companies. So you look at JD Logistics or JD.com, some of the companies that are pushing innovation and access into tier 2 and tier 3 cities will play with that. So what we did in the series of moves recently, what would I need to see? I think it would be Xi Jinping saying, whoops, we made a mistake, we're open for business. I don't think he'll do that. So I don't think we'll be hugely involved with China. The other thing that I think is, and we've seen this in the crypto space, by shutting open source movements down, which is what they're doing.
Right.
All open source movements, no. I think this is going to give the US a competitive advantage. So we have allocated more of our innovation assets here in the US because of what's happening. China was going to be one of our biggest competitors. We saw them in the AI space, making the league tables in chips. I'm not so sure. I think they have to do some house cleaning right now that we probably do not understand all the causes, but I think there's social unrest. That would be my guess. I think this is much more than China. As Rupal on the last panel said, France is becoming very innovative,
right.
And Southeast Asia has stolen the march from China. So companies like Sea, it's a social media, social commerce gaming company, It's exploding throughout the world, and capital is shifting towards that kind of name because there are big populations in Southeast Asia and Latin America as well.